Okay, people, how y'all doing out there in YouTube world? Dr. Business, back at it again. Another week, another video. Today's topic is Brian's rules, actually Dr. Business rules as it pertains to manage the 5 factors that affect your credit score. Let's go ahead and get started. I'm glad that you're back with us. By now, if you watched the other video, if you haven't watched it already, please watch my other video. I talk about the 5 factors that affect your score. We did listen to your comments. I'm trying to do a little bit better. We got better mic here. Hopefully my focus is much better. I know my focus is a little bit off, but anyway, as long as the content is good, we're gonna keep this thing going. On today's video, we're gonna talk about the 5 factors, but a little bit differently. We're going to talk about my rules as it pertains to managing each one of these factors. A little bit of a different topic, because again, on this same particular topic, there's so many misconceptions about what you really need to do as far as managing your credit. So let's get straight to it. If you do not know who I am, as I mentioned earlier, Dr. Business. I help entrepreneurs navigate and solve the complexity of starting their dream business so they can live their life of their dream, get off the self-endless, defeating, pointless rat race they're currently in, and take charge of their future through business ownership. So that's what I do, and I'm going to be noting for my book, our new book that just came out, 3 Paths of Lending. You want to make sure you take that book, buy that book. There's going to be links in the description below, but I'm not going to take too much of your time. Your time is very valuable to me. So I'm going to jump right in. We're going to talk about the 5 factors, but a little bit of a twist today. We're going to talk about my rules as it pertains to managing each one of these factors. So now, let's get straight to the point. As you should know by now, the first factor is payment history. Payment history, what is it? It monitors how you make your payments on time. I'm not going to get too deep into it. Watch the last video. I talk about it much more deeper, but I have a few rules. One of the rules is, number 1, make sure that you have something that you're making payments with every single month. I mentioned in the last video, there's some people that majority pay everything in cash. And surprise, the credit bureau is not owned by God, okay? Nobody is tracking everything that you're paying in cash. So my first rule is gonna be, you must have a trade line on your credit report that you're making payments on that is being reported on a monthly basis in order for you to benefit from this 35% that FICO evaluates. So again, you must have a trade line. You have to have some accounts open in order for you to benefit from this 35% to what FICO evaluates. Number 2, and this is kind of, self-explanatory. It should be common sense, but common sense, as you know, is not usually commonly practiced. You need to make sure that you're making your payments on time. This is such a big thing. I see people messing up on all of this. Make sure that you're making your payments on time. Now, technically speaking, I do want you to understand this and know that in order for you to get a late payment on your credit report, you actually have to be 30 calendar days late. Okay, there's 2 different dates that you need to be aware of. There's the due date that is set by your credit card issuer, the trade line issuer, car loan, whatever trade line we're talking about. And then there's also the 30 days late. You must be 30 calendar days late for it to be reported on your credit report as being a late payment. So making sure that you're making your payments on time. Number 1, you're gonna save a lot on late fees and all these other fees that lenders charge. And then secondly, it will not affect this 35% to what FICO evaluates if you make your payments on time. So those are just really hugely important rules that I want you to make sure that you're managing as it pertains to 35% payment history. So now, let's talk about the second factor that affects your credit score and what is Brian's rules as it pertains to this factor. 30% of your credit is based on utilization, amounts owed, whatever you want to call it. And we know by now that Dave Ramsey has been lying to people like Dave Ramsey, telling people to cut their credit cards. You cannot have a good credit score unless you have credit cards. That's just a fact, okay? I didn't make the rules. Get mad at the people that made the rules. Let's talk about now how to manage this and what are Dr. Business's rules that he wants you to abide by when it comes to managing your credit. So number 1, I have 2 things here. I have what I call a 30-50 rule. And what I'm telling you is, do not go above 50% of what the limit is. Let me slow down for just a second. I gotta remind you what utilization is. Utilization is balances in relation to limits on all open revolving accounts. Again, balances in relation to limits on all open revolving accounts. Revolving accounts are what? Credit cards and credit cards only. So for example, you have a $1,000 limit and a $500 balance, that means you're 50% utilized. If you have a $1,000 limit and a 30% balance, that means you're 30% utilized. Dr. Business says he has what is called, the first rule is a 30-50 rule. What do I mean by this? When you're seeking financing, you want to keep your balances below 30% of what the available limit is. When you're not seeking financing, I actually allow you to go up to 50% what the available limit is. Why is this? So number one, why do you need to keep your balances below 30% of what the available limit is? The reason why is, once you go above 50% or greater, or what the available limit is, you start to take a hit on your credit score as it pertains to this 30% of what FICO evaluates. So if it's below 30%, it does not take a hit on your score. So when you're seeking financing, you want to keep those balances below 30%. And there's that old joke, you heard me say it before, banks only lend money to people who don't look like they need money. So if you are above 50%, you look desperate. And lenders will consider you a high risk because your balance on your revolving accounts, as far as your utilization, is greater than 50%. So now, you probably might think, well, Brian, can I just keep it below 30%? Why are you telling us to get it up to 50% when you're not shopping for credit? This is why. There is such a thing called a high past balance. A high past balance is only monitored on revolving accounts alone. Every other account, there is that initial balance. You know, when you buy your car, house, or whatever it is, there's that initial balance and you pay down that balance. A high past balance is only monitored on revolving accounts alone. And what is this? This is a track that monitors the highest balance you've ever had in a revolving account. And what I've seen in my years in this industry, lenders gauge the high past balance to determine what you can get qualified for any future unsecured credit. Let me make it make sense. In a real life scenario, let's just say you had two twins. They're both the same age, they look exactly alike, okay? They had the same degree. Twin number one has two revolving accounts. These revolving accounts, one of them has a $1,000 limit, one of them has a $500 limit. Twin number two has two revolving accounts, one with a $5,000 limit, one with a $10,000 limit. Twin number two, high pass balance on the first card that has a $5,000 limit is $3,500. Let's just say $4,000. The second card that has a $10,000 limit has a high pass balance of, let's just say, $8,000. Twin number one has those two cards, one with what? A $1,000 limit, the second one with a $500 limit. The first card, let's just say, has a high pass balance of only $500 because it has a $1,000 limit, and he's been listening to my rules as far as the 50%. The second one has a high pass balance of only $150 because it's a $300 limit, and he's been listening to my rules as far as don't go above 50%. So now, if both these twins, identical twins, same age, same degree, same job, same income, if they both walk into a bank and apply for a line of credit, guess who will be qualified for a much higher amount? Twin number one with a $1,000 and $500 credit card, or twin number two, which has $10,000 and $5,000 credit card and has proven history to handle a high balance in the past? Well, duh, twin number two will get approved for a much higher amount. This is the reason behind this, the madness behind this theory as far as 30-50 rule. I want you to maintain low utilization, yes, when you're seeking financing. Don't get it above 30% to what the available limit is. But when you're not seeking financing, I actually tell you to go ahead and increase that limit all the way up to 50%. Why is this? So you can create a much higher past balance. Because the goal is, again, for you to be able to walk into a bank in the future and qualify for a high line of credit. You don't want to be holding on to $1,500 credit cards for the rest of your life. You want to be able to, especially as entrepreneurs, you want to be able to have the ability to go out there and borrow $50,000 or $100,000 in unsecured credit solely based on your signature. You will not get to that point unless you have a high past balance, that you have a proven ability, a proven track record where you can manage high balances and pay them down. And that only happens when you tap into creating much high balances in your revolving accounts. Now, this leads me to rule number 3 as it pertains to utilization. Put this on your calendar now. I tell each one of my clients, request a limit increase once every 6 months on all your revolving accounts. That is the only way that you can increase the limits on your card and you can start playing the twin number 2 game, the $5,000, $10,000 credit cards, and you keep growing it. If you start off with a small credit card, once every 6 months, request a limit increase with your card issuer. Tell them that I would like to limit increase. And whenever you're requesting a limit increase, preferably you want that balance below 30% of what the available limit is. Again, banks only lend money to people who don't look like they need money. So now if you have a higher limit, 20, 30, or 40,000, it's much easier, much better to play around with this 30 and 50 rule, if you see what I'm saying. So anyway, number 1, as it pertains to utilization, what do? You must have revolving accounts. Number 2, as it pertains to utilization, must understand the 30-50 rule. 30% when you're seeking financing, 50% when you're not seeking financing as far as utilization. Rule number 3, as it pertains to utilization, you must request a limit increase in each one of your revolving accounts once every 6 months. That is the way you can grow from having $1,000, $500 card, and now you can get to a point where in 6 months it's $2,500. In another 6 months, then you're looking at a $5,000 or $7,000 card. Within about a year or two, everybody that is watching this video should have a $25,000, a $50,000 line of credit in each one of your revolving accounts. That's how you create a strong credit profile. Hopefully you understand as to all the rules as it pertains to utilization. Let's move on to our third factor that we're going to be talking about, and we're going to talk about Brian's rules here. Now, let's talk about the 15%, which is length of credit history, and what are Brian's rules as it pertains to this factor. 15% of your credit, you should know by now, is based on length of credit history based on the oldest account reporting on your credit profile. So now, this is pretty self-explanatory as to how to manage this. How do you manage this? Well, keep your account, the longer the earlier you start building your credit, and the longer you maintain these accounts, the more you would benefit from this 15% of what FACO evaluates. Because again, it's based on how long your credit history has been. And the only way to do that is, of course, open up these accounts and keep them as long as you can. This is why I say credit cards is really so important. I mean, we just talked about 35% payment history, 30% utilization, and now we're talking about 15% types of credit. And again, I'm still emphasizing on credit cards because I want you to think about this. Every single account that you have that is not a credit card, you do want to make the last payment. Your auto loan, student loan, a mortgage, whatever it is. You don't want to keep these accounts forever. You want to make the last payment, you want to own the asset, and you don't want to deal with these people no more. But after these accounts fall off your credit, you do not benefit from this 15% to what FICO evaluates. So what is the best way to always maintain this benefit as far as 15% of what FICO evaluates? In my opinion, it's through revolving accounts and through credit cards, okay? You guys are gonna get sick of me talking about credit cards. And actually, this is what I got for you. I'm gonna be making another video and I'm gonna talk about my theory as to why lenders care so much about these credit cards. And I got a little theory that I think you're gonna like. But again, we need to understand, number 1, 15% of credit is based on age of credit history, which is the oldest item reporting on your credit profile. The only way to get this is to start building your credit at an early age. One of my advice that I talk about with parents is start building your children's credit at an early age. I think now you can open up credit cards at like 13. Get them a credit card and teach them a little bit of responsibility. But again, it will help them with this 15% to what FICO evaluates, which is truly very important. Another way to kind of, what I consider tricking the system, there is such a thing called authorized user accounts. Authorized user account is an account, it's not your personal account. Let's just say, for example, you ask a friend or a mother or your partner to add you as an authorized user on their revolving account. Let's just assume this revolving account has really great history, has been open for a certain period of time. That credit history, once reported on your credit report, you will start taking advantage of the length of credit history of that credit if it's been open for some time. So that's another way to kind of, you can say trick the credit system, but I will put this comment out there. FICO did realize a couple of years ago how people were taking advantage of the authorized user scheme, and they had pretty much accounts heavily supported only by authorized users, and they came up with a new scoring algorithm. When they see that your account is just heavily supported by authorized users, they actually remove the authorized users out of the equation, and they just rate the account based on your individual accounts and individual accounts alone. So you want to, when you do the authorized user thing, you don't want to have too many authorized users. Maybe 1 or 2 authorized users is enough. Honestly, I just say don't go more than 1. And this will kind of help you in case you're in a position where you need to extend your credit history, you have a very young credit history, or it also helps with utilization, a few other different factors that we're going to talk about here. But anyway, let's not get off subject. 15% of your credit is based on age of file, which is the longest account reporting on your file. What are Brian's rules as it pertains to this? You need to get one credit card. Why am I talking about credit cards? Credit cards is the only type of account that doesn't have an end date. Okay? So you can literally have it forever. Get one credit card and have that thing forever. Okay? Next thing is types of credit. 10% of your credit is managed by types of credit. This is where you benefit from having, installment loans, auto loans, personal loans, student loans, mortgage loans, revolving accounts, retail cards, HELOCs. This is really funny, but believe it or not, negative accounts are a type of a trade line on your credit report. This happened to me one time when I was fixing somebody's credit and it shocked me. Well, I noticed that once we removed this collection, I believe it was a charge-off. We removed this charge-off that was on his credit report. And this charge-off was the oldest account that was on his file. In addition to that, this charge-off was also a negative item. So what happened is he actually saw a score reduction because we affected the types of accounts that was on his account. And then secondly, we got rid of the oldest item reporting on his credit profile, which again, it was our intention to get rid of it, but I'm trying to help you understand how easy it is to manipulate this equation, the FICO scoring algorithm. It literally is just a math equation. And regardless of whatever type of account it is, given the fact that 10% of your credit is based on the types of accounts that are on your credit profile, it doesn't matter what they are, positive or negative, they're all included in this mix, if you want to call it that. So I just kind of want to throw that out there. And we're going to make another video discussing the different types of trade lines that are on your credit report. Now, I'm not saying keep collections and charge off your file, but I'm just giving you an example, a prime example as it pertains to types of credit on your file. And as it pertains to the rule when it comes to this factor, this kind of, it happens naturally, as I said in the last video. As you continue in your credit world and building your credit, you are gonna have an auto loan, you are gonna have a student loan, you are gonna have a mortgage loan. So you will have what I call a diversified credit profile. Now, do not go out there and intentionally get collections and charge off and bankruptcies. That's not what we're trying to say on here. Anyway, lastly, let's talk about last factor on your credit, which is based on new credit or inquiries. That affects 10% of your credit. So what are Brian's rules as it pertains to this? Number one, I always say, as it pertains to inquiries, you've heard my old joke before, banks only lend money to people who don't look like they need money. So if you have a lot of inquiries on your credit report, you look desperate. I always say, my rule is you cannot have more than 6 or more inquiries per bureau within a 6-month period. So I give you permission to get 1 inquiry per bureau every single month. Because when you pull your credit report, not each application will pull all 3 credit bureaus. Keep in mind, we have 3 credit bureaus. If you don't understand where I'm at, watch the last video. I talk about the 3 different credit bureaus and what affects your score. But there's 3 credit bureaus. So I'm allowing you, number 1 rule is 1 inquiry per month. So 6 or more inquiries within less than a 6-month period is too many inquiries. The same thing as it pertains to accounts, new accounts that you've opened. Once you start opening up new accounts, you will start seeing a positive hit on your credit, especially if you don't have anything on your credit report. So, the rule is 3 or more accounts within a 6-month period is too many accounts. You cannot open more than 3 accounts within a 6-month period. You have to keep that down. And of course, every new account is going to be reported on all 3 credit bureaus. So, those are the rules as it pertains to new credit or inquiries. Make sure you manage your inquiry count low. Don't go out there to these used car salespeople or these car lots that say that we're gonna find the best financing for you, and then they send your application to like 10,000 lenders out there. Next thing you know, your inquiry tanks because you have all these inquiries on your credit report, and your FICO score drops as well because 10% of your credit is managed by inquiries. So anyway, hope you understand. I talked about the 5 rules as it pertains to the 5 factors. We talked about payment history and what my rules are on that. We talked about utilization and my rules on that. We talk about 15% of your credit, which is types of credit, and what my rules are as far as managing that. And then lastly, we finish off with new credit and inquiries and how to manage each one of these factors. Hopefully that makes sense. You do want to grab my book. I expand on all of these things, so it'll be a constant reminder. You can quickly grab it. There's a chapter on there that talk about Brian's Rules, Dr. Business Rules as it pertains to managing your credit. So definitely do check that out. And again, we run one of the best entrepreneurs incubators out there, and we help entrepreneurs just like yourself. If you're an entrepreneur out there, if you're thinking about starting your own business, you definitely want to check out my training. There's going to be links in the description. I talk about what we do and what we can help you with. But anyway, I appreciate it, and I'll see you in the next video. Thank you so much.